Welcome to the Deep Dive. Today, we're really getting into the weeds on Navin Fluorine International Ltd, or NFIL. We're looking at their recent Q2 and half-year FY26 earnings materials. And our goal here isn't just, reading off the numbers. We want to understand the strategy underneath. For you, the listener, we want to make clear, where did this, frankly, explosive first-half performance actually come from? And maybe more importantly, what are these big new capital expenditure plans telling us about where they're headed? What's the future look like?
Exactly. I mean, this is a fascinating look at a specialty chemical company, really leaning into its strengths in fluorination chemistry. And what really stands out, I think, is how they're translating that financial momentum, that operational success, directly into concrete strategic investments. It's growth, yes, but it's also like a planned transformation backed by capital.
Okay, right. Let's unpack that. Starting with the Q2 numbers, the quarter ending September 30, 2025. They were, well, pretty extraordinary. Consolidated sales hit ours, 758.4 crores. That's what, about $91 million US, a jump of 46% year on year. Huge increase.
It really is. But if sales were strong, the profit numbers were almost seismic. Operating EBITDA shot up at 129% year on year, came in at Rs 246.2 crores. And that pushed their operating EBITDA margin to a, frankly, stunning 32.5% for the quarter.
32.5%. Wow, that's up from 20.7% last year.
Exactly.
That's what, almost 1,200 basis points? That feels like more than just, a good quarter or favorable pricing. Is it structural? What did management say?
Yeah, good question. And their commentary suggests it is largely structural. They pointed out that maybe 80 to 90% of that underlying EBITDA growth came directly from volume expansion.
Okay. Operating leverage.
Precisely. Their plants are running harder, spreading those fixed costs over much more product. Classic operating leverage playing out beautifully. But it wasn't just volume. They also mentioned favorable pricing helped, sure, but also a better product mix, shifting towards higher value stuff.
Right, the specialty chemicals and advanced intermediates probably pulling more weight.
Exactly. So it suggests they're successfully moving the whole portfolio up the value chain. It looks like a structurally higher margin profile now.
And their own confidence seems to reflect that, doesn't it? They actually raised their guidance for the full year.
They did. The FY26 operating EBITDA margin guidance, originally pegged around 25%, is now aiming for a range of 28% to 30%.
So they clearly believe this isn't just a blip. They think this kind of margin level is sustainable.
It certainly signals that.
Yeah.
They must expect the new high-value projects, those we'll talk about, to keep pushing that margin profile upwards. Oh, and just a quick note for investors, the board also declared an interim dividend, Rs 6.50 per share. So even with big spending plans, they're keeping shareholder returns in mind.
Okay, so that strong performance sets the stage. And this is where it gets, I think, really interesting. The board took that momentum, those profits, and approved two pretty chunky new strategic CapEx projects. And what's notable is they're funding these entirely through internal cash flow, right? Even after raising Rs 750 crores via that QIP in Q2.
That's right. They've got the QIP funds as a cushion, maybe, but these specific projects are bankrolled by their own earnings. It's like directly reinvesting today's success into tomorrow's growth engine.
Smart. Let's break them down. Investment A, first, the R32 HFC capacity expansion. What are the details there?
Okay, so this is the larger one. They've approved Rs 236.5 crores. This is to build additional capacity for HFCs, specifically equivalent to up to 15,000 metric tons per annum, or MTPA, of R32. And this is at their Surat facility.
R32, that's used in air conditioners, refrigeration, right? Why such a big focus there? Isn't that market sometimes, prone to being a bit commoditized, price swings?
That's the usual concern, yeah.
Yeah.
But this isn't just a simple build more capacity play. It's strategic. It ties directly into the global regulations.
Ah, you mean the Kigali Amendment.
Exactly. The Kigali Amendment to the Montreal Protocol, it mandates phasing down the high global warming potential of the high GWP refrigerants globally. And R32 is one of the key lower GWP alternatives everyone's shifting towards. So
Yeah.
NFIL is positioning itself to supply that mandatory transition.
So it's riding a regulatory wave, essentially.
Pretty much. And crucially, this capacity uses NFIL's specific production entitlement under that protocol. So it gives them a bit of a competitive moat, you could say. It's not just open season. Management sees the global demand for R32, if you exclude China, growing at around 5% CAGR. So there's steady underlying growth too.
Okay, that makes the investment feel a lot less risky. What kind of return are they expecting, and when does it come online?
The potential payoff looks pretty substantial. They're projecting peak annual revenue from this new R32 line of somewhere between R600 and 825 crores.
Wow, okay.
And the timeline is relatively quick commissioning expected by Q3 of FY27.
And are they locking in customers or playing the spot market?
A mix, it sounds like. Management mentioned a balanced approach, locking in some volume with multi-year contracts, maybe 4 or 5 years to secure a base load, but also keeping some capacity open to capture potentially higher prices in the spot market if conditions are right. Seems sensible.
Okay, so that's the big regulatory play with R32. But the second investment seems quite different. Investment B, the specialty MPP debottlenecking. Tell us about that one.
Right. Investment B is almost the opposite in strategic terms. Much smaller check size Rs, 75 crores, and it's highly targeted. This is for debottlenecking their multipurpose plant, the MPP, down at Dahej.
Debottlenecking. So basically squeezing more out of an existing asset.
Essentially, yes, sweating the asset, as they say. But the key here is why. It's about deepening a specific partnership. This added capacity is dedicated to making one particular thing, a key fluoro intermediate. That's like a complex chemical building block.
Okay.
And it's needed for a brand new agrochemical active ingredient, an AI, being developed by one of their global innovator partners.
So NFIL becomes a critical supplier for a new, potentially major agrochemical product for someone else, embedded in their supply chain.
Precisely. It makes them a much stickier, more indispensable partner, high-margin, bespoke chemistry.
And is there already demand for this? Have they got orders?
Yes, that's the validation. They mentioned they've already received a firm order for the calendar year 2026 for this specific intermediate. They expect this debottleneck capacity to generate peak annual revenue of about 140 to 160 crores, also targeting commissioning by Q3 FY27. So a quick payback on that smaller investment.
Right. That shows the high value of these specialized contracts. Okay, so those are the future plans. Let's quickly touch on the engines driving the profits today that are funding all this. 3 main segments, right?
Yep, CDMO, HPP, and specialty chemicals.
Let's start with CDMO, contract development, and manufacturing. That one really stood out in the numbers.
It absolutely did. Star performer, massive growth, 98% year-on-year in Q2 FY26. Pulled in Rs 134 crores in revenue for the quarter. A couple of key things happened there. They finished up supplies for a pretty significant order with a major European client.
And they expect more from them.
Yeah, they flagged a repeat order expected sometime in calendar year 2026. So good continuation there.
And wasn't there progress on their newer CGMP4 plant as well?
Yes, exactly. Validation batches for another European CDMO partner's molecule kicked off in that CGMP4 facility. They're aiming for commercial supplies starting around January 2026. And they mentioned having strong visibility on that for about 3 years out, which is great for planning.
Okay, solid progress. But there was one detail that really caught my eye. The report mentioned the CDMO business was audited by 3 major global innovators recently. Why is that specific detail significant? It sounds like just routine checks.
But it's much more than routine in this world. In CDMO, especially complex chemistry like fluorination, your intangible assets are almost as important as your physical plant.
Intangible assets, like what, trust?
Exactly. Trust, IP protection, quality systems, your regulatory track record, these things are paramount. So the fact that 3 separate global giants audited them, presumably based on successful past deliveries or potential future work, and apparently gave them the thumbs up, that's a huge validation.
Right. It's like getting a gold star for confidentiality and quality from the toughest examiners.
Precisely. It means NFIL is seen as a reliable, high-quality partner capable of handling sensitive, high-value projects. That kind of reputation is critical for winning future business, long before contracts even get discussed. It's a massive competitive advantage.
Got it. It's a trust metric that unlocks future deals. Okay, moving to the second engine. High-performance products, or HPP, grew a solid 38% year-on-year. What's the strategic focus there?
Well, the big infrastructure piece is the AHF project and hydrofluoric acid. This is apparently in mechanical trials now, expected to commission soon by Q3 FY26. That's foundational. But the really interesting strategic move is the development work they're doing on high-purity electronic-grade HF.
Electronic grade, so for making computer chips and things.
Exactly. Semiconductors, maybe flat panel displays. It requires incredibly high purity levels. So this is NFIL trying to move up the value chain. Instead of just selling HF, which can be more commoditized, they want to sell this ultra-pure specialized version. Much higher value realization per kilogram of HF.
Makes sense. From bulk chemical to precision ingredient.
Yep. Classic specialty move.
And finally, the third engine, specialty chemicals. Also strong growth, 39% year-on-year. What's driving that now?
A couple things. That fluorose specialty plant they commissioned late last year, December 2024, I think, is now really starting to contribute meaningfully to the numbers in Q2. And the other big project progressing is the one with Chemours, manufacturing something called Optin.
Opt-in, right. Remind us what that is again and why it's relevant for, someone listening to this.
Sure. Optin is a specialized fluid used for immersion cooling. Think about massive data centers full of hot servers running AI models or cloud services. You need really efficient ways to cool that equipment. Optin is a fluid you can literally submerge the electronics in because it doesn't conduct electricity, and it's very effective at removing heat.
So it taps into the whole data center boom, AI infrastructure growth.
Exactly. The demand for these advanced cooling solutions is expected to grow massively with AI and cloud computing. So this Chemours project positions NFIL right in the middle of that future growth trend. That one's on track for Q1 FY27 completion.
Got it. Very forward-looking product.
So if you try and tie it all together, you see why those margins are expanding and look sustainable. It comes back to what they call their 3P approach.
Right. The 3 Ps.
Product, platform, and partnerships. They focus on picking the right high-value products,
Right.
developing the specific chemical platforms the technologies needed to make them efficiently, and building deep partnerships with global innovators who need those products. The whole philosophy seems geared towards maximizing the value they get for their chemistry expertise, not just selling more volume, moving up the value chain constantly.
So wrapping this up for you, the listener, what's the key takeaway here? The Q2 and H1 numbers, well, they definitely confirm NFIL is hitting on all cylinders operationally right now. The execution is clearly there. But maybe the bigger story is in those two new CapEx projects. They're like a roadmap for where the future value is coming from. One secures their place in that regulated, lower GWP refrigerant market. The other deepens those high-margin specialized partnerships in things like agrochemicals. It's all about scaling up specialized production.
Which leads to, I think, a really interesting final question for you to ponder.
Uh-huh.
NFIL's strategy clearly hinges on taking these recent R&D wins, things like the electronic-grade HF, that new agro intermediate, and successfully turning them into large-scale, high-margin commercial businesses. We see the groundwork with the CapEx and the validation from those CDMO audits. But the key question is, how quickly can they transition? How fast can these new high-value platforms become the dominant part of their revenue mix, say by FY27 or FY28? Because that's where the real long-term value compounding will kick in. Something to watch.
A great point to keep an eye on. Definitely something to track in future quarters. Thanks for joining us for this deep dive into Navin Fluorine International. Keep digging, keep learning, and we'll catch you on the next one.